right, man, today we gonna battle the restaurants. Which one of these restaurant stocks is the one? We're gonna go through some stuff, some real key metrics that you need to be looking at when you're looking at a business, like PE ratio. But we also gonna look into free cash flow, net margin, and what net margin is. We look at the revenue, what percentage of the revenue is profit? That's your net margin, right? So we're gonna break through that so you can know how much money they making. All right, we'll go through free cash flow, which is what they got left over after they pay everything. And this is where your dividends, your share buybacks, and all that come from. So listen, you gonna wanna see this. So make sure you like, make sure you subscribe to the channel and share this. Get your pen, get your pad, because y'all told me y'all like these comparison videos. So we're gonna give it to y'all as the easy way to break down. I'm gonna tell y'all which one, if it was me, which one I would pick. So today, we're gonna definitely talk about Domino's, and we're gonna talk about Chipotle. Y'all may know it as Chipotle, ticker symbol CMG. Of course, they about to do that 50-to-1 stock split. That's gonna be crazy. I've owned about 100 shares since it was $425 back during the pandemic. March 23rd, I got it, and it's been running since then. I have the one that been telling y'all Chipotle, 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 Chipotle. Now y'all get it. You feel me? It's just been on a tear. So let's go through it. The first thing we're gonna look at is the market cap between the two, right? So Chipotle has a $78 billion market cap, and Domino's has a $17 billion market cap, which tells us that Chipotle is the bigger brand. So we definitely want to give them that for that. They are the bigger brand. They are worth more in value. Market cap is how many shares the company have times the stock price. Right now, Chipotle's stock price is somewhere around $2,868. Right now, Domino's stock is about $496. So there's a big difference in that, right? But it is stock price time how many shares they have. That is the market cap. Now, the market cap will keep increasing or decreasing based on the stock price. So you need to know that. As the stock goes up, you see the market cap going up. That's why Apple is a such and such almost $3 trillion company. That's why Nvidia. That's why the market cap keeps increasing, because the stock price keep going up. Next, when we talk about free cash. So we talk about cash on hand. We talk about free cash. We talk about how much money the company has after they paid off everything. And they use this money to pay dividends. They use this money to buy back shares. They use this money to make acquisitions. This is the money that they use that actually comes to you. If they don't, you get it in the form of stock increase from them adding value. So right now, Domino's has 130 million in free cash. Chipotle has 1.2 billion in free cash. Now, that's good. Now, even though they are extremely different in market cap, still 1.2 billion is heavy. Now, this is where this makes more sense at. Now, in debt. Now, debt is what they owe, liabilities, credits that's due, credit they've taken on. Right now in debt, Domino's has $5 billion in debt. $5 billion in debt. Chipotle has $4 billion in debt. Now, the dope part about that is I didn't separate it between long-term debt and short-term debt. Typically, the short-term debt is way more important because that's the debt that's due in anything under 12 months. So we want them to take care of that. Long-term debt can always be restructured. It can be out 20 years. They can do so much with the long-term debt. But for me, we like companies with little to no debt. So we'll definitely have to give Chipotle, remember, $78 billion. They got $1 billion in cash, $4 billion in debt. So Chipotle is cheaper in debt. Now, let's talk next about PE ratio. Now, we know that the PE ratio tells us how much we are paying for $1 of the company's profit. Now, the PE ratio tells us if a stock is expensive or if it is cheap compared to the S&P 500. Now, as we can see right now, Domino's has a 33.5 PE ratio. So you're paying $33 for $1 of Domino's profit, whereas you're paying $64 for $1 of Chipotle's profit. Now, of course, the more growth a company has, that PE will go up a little more. But for right now, we're going to say that We got to get that to them. All right, for all my dividend babies. Where's my dividend babies? I see y'all. Y'all driving for dollars. Chipotle does not pay a dividend at all. What I do want us to understand that just because a company doesn't pay a dividend doesn't mean a company isn't a great company. I'm gonna say it again. Just because a company does not pay a dividend does not mean a company is not a great company. But as we can see right now, Domino's pays a 1.23% dividend, which comes out to be $6.04. $6.04 dividend for Domino's. So we definitely got to get that one to Domino's. Just because they paid a dividend, so that means Chipotle is putting all their money into growth. Now, here's where their dividend is going to be dope. When it comes to revenue, Chipotle's revenue is up $9.8 billion. That means it is up, when I did the numbers, is up 14% from 2022. Because it's the first quarter, we going into the first quarter of Q1. Second quarter, these numbers ain't came out, so this is based on Q4. They up 14%, while Domino's have 4.4 billion, is down 1.27%. All right, so the revenue, we're gonna get that revenue to Chipotle because they increased their revenue by 14%, whereas Domino's went down by 1.27%. Next on the list, we got net margin. Now, this is important because this tells us what percentage of the revenue is profit. What percentage of the revenue is profit? So, $4 billion in revenue, 11.5% of it is profit. So off of $4 billion in revenue, 11.5% is profit. That's not bad, right? That's actually that's considered strong. For Chipotle, 12 off $9 billion in revenue, we see 12.45% is profit, which lets us know that they're having more profit than them. They're bringing in more revenue and they got a higher net margin rate. So that tells us they're good at operating, generating cash, but then turning that cash into profit, right? Turning that operational cash flow into profit. We definitely got to get this one to Chipotle. Now I want to give y'all a number. 5% or less, so 5% is considered okay. Anything less than 5% is bad. 10% is strong. Anything above 20% is phenomenal. So we're gonna gotta get that to Chipotle. Next, we're gonna look at our ROIC, which is return on invested capital. This tells us that the company can put some money out there and then they can get a good return on that money. Now, for this, anything above 3% is phenomenal. Anything above 10% is 10 to 15% is great. Anything above that is just out of this world. So as we look at the ROIC, Domino's got a 51. Ooh. That means Domino's could get some money. That means Domino's know how to go make an investment and get some money on that investment, right? And then we got Chipotle at 19.81%. Now, anytime you see that, that's good. That means they can do some things with some bread. But we got to keep it 100. We got to get this into Domino's for sure. And last but not least, man, let's look at the 5-year return on both stocks, right? We're talking about 5 years gives us a nice body of work. It tells us what the company has done. At this point, we're talking about from the pandemic, 2019, 21, 2, 3, now we're in 2024. The 5-year return on Domino's is 90.53%, which is actually good. You know what I'm saying? I like to get 5 years, anything over 100%. That means you give me 20% a year. They're real close to it. But let's just talk about Chipotle. Let's just talk about Chipotle with 302% stock price return in 5-year time span. The reason why that's amazing, because that means you done did some hell of a work with your money in 5 years investing with this company. Let's go over it again right quick, and then I'll give y'all my personal stock pick. And you might be kind of surprised. We're talking about market cap. Market cap definitely got to go to Chipotle because they're bigger. Cash on hand, free cash flow, got to go to Chipotle. Actually, the debt is down, so we're going to go to debt with Chipotle. PE ratio, now I'm not going to lie, Domino's is actually cheaper than Chipotle because the PE tell us that, so we go with Domino's with that. Because Domino's paid the 6%, the 1% dividend at $6, we not mad at that for sure. Chipotle definitely has better revenue. They increased about 14%. We love that. A company that's growing that top line. Top line means revenue, right? The ROIC is at 19, which is a great ROIC. But as we can see, Domino's is knocking it out the park with 51.5%. And that 5-year return is no comparison, even though 90% is good. Now, what I want you to understand that both of these are great companies, and sometimes you don't have to pick. But for instances, and in this case, we definitely gonna roll with none other than, man, y'all know I'm going with Chipotle, man. Y'all know I've been rocking with Chipotle since the pandemic, man. We ain't playing no games. 50-1 stock split. We're gonna let it pull back a little bit. We're gonna buy a whole bunch more. Chipotle, I'm gonna have over 800 shares, and I'm definitely gonna show y'all, man. It's your boy, the Wall Street Trapper. Listen, before we go, make sure you like, subscribe, and share this. Make sure you tune in into our show each and every Tuesday at 7 p.m. Eastern time. It's called Trapping Tuesdays. I'm telling you, it's gonna blow your mind the way we get down. But make sure you also download it on all podcast platforms. It's your boy, the Wall Street Trapper, man. Salute. See y'all in the trap.